And I'm Mira.
So, if you just looked at the U.S. inflation data this morning, you'd probably think the economy was taking a victory lap, right? But, I mean, you look 7,000 miles away, and there's a $73 billion defense mobilization, plus a naval blockade, and they're basically threatening to pull the rug right out from under it.
Yeah, that is kind of the ultimate tension driving Wednesday's action. We're watching this practically perfect domestic economic climate just collide head on with a massive, really unpredictable offshore storm.
Exactly. So welcome to the deep dive. Today is Wednesday, July 15, 2026. And just looking at how things settled, major U.S. equity indices managed to trend higher, though the NASDAQ 100 saw some really wild whiplash volatility.
Right, totally.
S&P 500 futures finished near session highs at 7,615.75, while 10-year Treasury yields fell and the U.S. dollar softened a bit.
Yeah, and today we're taking our stack of sources to unpack this intense tug of war for you. We've got this amazing wholesale inflation data providing a massive tailwind, and it's fighting against mounting geopolitical anxiety in the Middle East that honestly threatens to upend the whole board.
Right. And before we jump into the actual mechanics of all this, we do need to make it absolutely clear to you, the listener, that this deep dive is for market context and discussion only. It is not personal investment advice or an investment recommendation.
Exactly. We're just here to help you understand the baseline you're operating against, to figure out why the markets are reacting the way they are, not to tell you what to buy or sell.
Okay, so let's unpack this baseline for session one. The big question is, how did carryover inflation data, overnight geopolitical strikes, and China's economic slowdown actually set the baseline before New York even opened?
Well, to understand the mood in New York this morning, we really have to rewind to that incredible momentum carried over from Tuesday.
Oh, yeah, the CPI data.
Right. We got that U.S. June CPI report, the Consumer Price Index, and it dropped an unexpected 0.4% month over month.
That wasn't just a beat. That was like the best inflation report we have seen in 6 years.
Yeah, it fundamentally shifted the ground under the market's feet. So suddenly you have this huge risk-on disinflationary baseline. The market looks at that consumer price drop and just immediately starts pricing in a much friendlier Federal Reserve.
It's acting like a massive domestic shield.
Yeah.
And frankly, we needed that shield because while U.S. markets were celebrating the CPI print, the rest of the world was flashing some very bright, very red warning signs overnight.
Yeah, let's start with the overnight data from China because the whole global growth narrative is getting incredibly complicated.
That's all right.
They released their second quarter GDP, and the economy grew by only 4.3% year over year, which, completely missed the 4.5% forecast.
But that top line missed almost masks the real story, which is the internal divergence, right? I mean, we're looking at a sharp 18% decline in property investment, and retail sales are essentially flat, up a very weak 1.0%.
Wow.
Yeah, but then you put that right next to their industrial output, which actually grew at a robust 5.3%.
Wow.
So what's the mechanism at play here? Are they just, trying to manufacture their way out of a real estate collapse?
That's precisely what's happening. They're heavily subsidizing and exporting goods, especially AI hardware and green tech, while the domestic consumer is just completely tapped out.
Right.
The real estate sector, which traditionally drove a massive portion of Chinese wealth, is basically in a deep freeze. You can't just pivot an economy of that size overnight without friction.
And Wall Street sees that friction clearly. Major banks immediately slashed their China 2026 GDP growth forecasts down to 4.6%. When the world's second largest economy shows that kind of structural imbalance, it casts a shadow over everything.
Especially global demand for commodities and industrial exports, which honestly brings us to the most immediate threat to those commodities, and that is the pre-market military escalation in the Gulf.
Yeah, the geopolitical shock. So following a broken June ceasefire, the U.S. officially resumed a total naval blockade of Iran on Tuesday.
And it escalated rapidly. Overnight and into the early morning, specifically at 10 p.m. ET Tuesday, and again at 6 a.m. Eastern Time, Wednesday, U.S. Central Command launched consecutive waves of precision strikes on Iranian coastal defense and cruise missile sites near the Strait of Hormuz.
Iran retaliated, right?
Okay.
With projectile strikes across the region, which basically further shut down commercial traffic in the Strait.
Exactly. And you see headlines calling this an unpredictable natural disaster. But, Daniel, we really have to look at the mechanics of what the Strait of Hormuz actually represents here. Roughly 1/5 of the world's traded oil passes through that specific choke point.
Right, and I want to push back on that unpredictable shock narrative anyway. We have to look at this through the lens of game theory brinkmanship. It isn't just a random event. The Strait is a physical supply chain choke point being used for geopolitical leverage.
Totally.
And the interesting thing is, WTI crude actually fell initially during those 6 a.m. strikes before ultimately settling at $80.22, which was only up 1.1% on the day. So oil traders might not be fully pricing in a permanent closure yet.
Yeah, they're assuming this brinkmanship won't lead to a total prolonged shutdown. They're betting neither side actually wants a permanent closure, but it leaves the market incredibly vulnerable if that assumption is wrong.
Right. So we basically had this massive clash before the CPI relief fighting against overnight global headwinds and strikes. Let's take a quick break, and when we come back, we'll dive into what actually happened once New York opened.
Sounds good.
Welcome back to Session 2. So the question for this block is, how did traders weigh new inflation data against a surprisingly cautious Federal Reserve during U.S. trading hours?
Well, at 8:30 a.m. Eastern Time, the domestic data delivered yet another wave of sunshine. We got the U.S. Producer Price Index, or PPI, for June.
The wholesale side of inflation.
Exactly. What businesses are paying for goods and services, and it fell 0.3% month over month. That completely crushed the flat 0% forecast.
Wow, yeah. And the year-over-year numbers were just as telling, right? Headline PPI cooled to 5.5%, and core PPI cooled to 4.7%. This totally confirmed the CPI data from Tuesday.
It did, and the market reaction was exactly what you'd expect. S&P 500 futures rallied to a session high of 7,626.25.
And in the bond market, we saw 10-year Treasury note futures rally to a 909.34, pushing the 10-year yield down. So investors were aggressively buying bonds.
Buying the narrative with both hands.
Okay.
But the Federal Reserve was not quite ready to pop the champagne.
Shocker.
Right. At 9:51 a.m. ET, Fed Chair Kevin Warsh gave his congressional testimony, and he definitely threw some cold water on things. He literally called the disinflation data imperfect measures.
Imperfect measures. Okay, I have to challenge this a bit. Is the Fed's extreme caution already priced in by the market, or is this just central bank rhetoric as a policy tool?
Oh, it's definitely a policy tool.
Right. They see the CPI and PPI prints. They know financial conditions want to loosen, so they send out Warsh to keep things tight.
Exactly. He emphasized he still wants a leaner balance sheet. He also stressed that while AI productivity is structurally disinflationary, a sudden AI investment disappointment could cause capital to dry up completely.
And he wasn't the only one, was he?
Nope. At 12:57 p.m. ET, Fed Governor Lisa Cook advocated for rate patience. She argued that 1 month of data doesn't make a trend and pointed to upside risks from tariffs, the Middle East, and all those heavy AI investments.
Interesting. And meanwhile, looking globally, at 9:45 a.m. ET, the Bank of Canada held rates at 2.25%, dropping references to consecutive hikes.
Yes, signaling global banks are hitting pause to watch the oil shock.
Right. And domestically, speaking of buffers against that oil shock, the White House is actually considering extending Jones Act waivers to allow foreign flag vessels to move fuel between U.S. ports.
Which is a direct policy buffer against localized energy spikes.
Exactly. And on the defense side, at a Pennsylvania summit today, President Trump announced nearly $10 billion in new defense industry deals, demanding faster submarine and ship manufacturing, while the House drafted a $73 billion budget for the war effort.
That is a massive capital injection.
You'd think so, right? But despite that, the industrial sector, tracked by XLI, actually closed down 0.22% today. It's just a classic case of macro shocks overwhelming micro fundamentals. The broader fears just drowned out the specific funding news.
Yeah, absolutely.
So to summarize, the market absorbed the PPI cheer today, but it had to fight through a lot of Fed caution and heavy geopolitical defense spending. We're going to take one more short break, and then we'll get into the mega-cap tech narratives.
See you in a minute.
All right, welcome back for Session 3. The big question here. Which mega-cap tech narratives drove the stock-specific action today, and what's on the horizon? Mira, let's talk about ASML.
Yeah, so ASML released their Q2 earnings early Wednesday, and they posted a really strong beat, which initially boosted AI optimism.
Initially being the key word there.
Right, because reports quickly surfaced that ASML plans massive price hikes on their chip-making equipment, and TSMC immediately pushed back.
The margin war. The market impact there was pretty severe. The tech sector XLK sank 1.9% to close at 181.58.
Yeah, it really took a hit.
It perfectly illustrates how AI infrastructure is shifting. It's moving from simple silicon demand to physical supply chain choke points and margin compression.
Exactly. And speaking of silicon struggles, we got a really interesting report at 10:32 a.m. ET about Apple.
All this was wild.
Yeah, they are actively hunting for AI chip startup acquisitions. Why? Because their in-house M2 Ultra chips are reportedly failing to handle advanced AI workloads. So they're forced to remain heavily reliant on NVIDIA.
Yeah, which brings us perfectly to the closing bell. We finally made it to the closing bell where, S&P 500 bulls are celebrating a cooler PPI while NASDAQ traders are nursing some serious whiplash.
For sure.
And the most humbling news of the day has to be Apple hunting for AI startups after realizing their M2 Ultra chips aren't quite, ultra enough for advanced AI workloads, forcing them to keep buying from NVIDIA. I guess even a multi-trillion-dollar giant knows the feeling of bringing a butter knife to an AI gunfight.
Right.
So if your tech portfolio felt a little slow today, just tell your clients you're experiencing performance constraints and blame it on the silicon. Here's hoping tomorrow's trading is a bit more user-friendly.
I love that. Blame it on the silicon. But looking ahead to Thursday, July 16, we've got a lot to watch.
Right on the calendar.
At 8:30 a.m. Eastern Time, we get June U.S. retail sales, weekly initial jobless claims, and the Philly Fed manufacturing survey.
Okay, heavy data block.
Very heavy. Then at 10 a.m. ET, we have June pending home sales and May business inventories, followed by Dallas Fed President Lori Logan speaking at 12:30 p.m. ET.
We'll see if she echoes Warsh and Cook.
Exactly.
Yeah.
And then at 1 p.m. ET, there's a U.S. Treasury 30-year bond auction. And of course, through the close, constant monitoring of the Strait of Hormuz for any shipping or military escalation.
Yeah, that offshore hurricane is going to be front and center. Thank you so much for joining us for this deep dive.
Thanks, everyone.
What's your take on the brewing margin war in the semiconductor space? Let us know your thoughts in the comments below.